Hello and welcome to Homeownership, the Keys to Successful Homeownership. This is Kristen Cooper. I am a certified mortgage planning specialist as well as a certified divorce lending professional and military certified. I am so happy that you're here today. My intention through this workshop is to provide you with valuable information to where you can make an educated decision for you and your family to see if it's the right time for you to buy and also just to learn about the market and what's going on. So we're going to start off by giving you a little bit of feedback around what a certified mortgage planning specialist is. Now, you can go to anybody to purchase a home that is a loan officer. That's somebody that can help you with getting a home loan on the property that you're looking to purchase or refinance of a home that you currently own. As a certified mortgage planning specialist, I go through a higher degree of education. I take into account tax implications as well as overall wealth building and strategies. I am held at a higher degree and go through an additional amount of education in order to have that certification every year. Also, as a certified divorce lending professional, that is an additional certification that surrounds divorces. Unfortunately, there's many divorces and it is on the rise, so we want to make sure that your property, your mortgage, and your real estate loan is all taken into account and making sure that anything that revolves around that and that you are working with someone that's educated in that arena, which is the certification that I have as well. Military certified, I work with a lot of veterans. If you are a veteran, thank you so much for your service. My husband's still in the Air Force Reserves, and I have a lot of family members that were in the military armed services as well. So from the heart, I definitely want to just take a moment and say thank you so much for your service, and it's appreciated. I am the top 1% of my company in production. I have a team, and on my team, I have a assistant as well as another loan officer and a processor here in-house as well. So we make sure that we have all the resources available to make sure that your process with us is a happy process and that you're getting communicated with throughout the process. And then I'm a financial educator, so I also take time to educate on finances and credit, and we'll get a little bit more into that as well as we move forward. So now we're going to talk about the fears of purchasing a home. Now, a lot of you are probably here today because you want to purchase a home and have additional questions. And usually the questions come from fear, and we hear a lot in social media as well as on the TV. So you have every right to be fearful because of the information that you get. Now, fear can be bad when we allow it to control our decisions, but really, fear is good because it's simply a sign telling us we need more information. So what are your concerns today? That's what we're going to talk about. What is the biggest fear about buying a home? Now you can see here that there's a lot of different fears that were measured. And on this, you can see that the first one here is afraid of ending up with a mortgage payment that is too big. Now we're going to go through each of these fears and talk about them because they are valid concerns, and we want to make sure we address the information again so that you can make an educated decision by the end of this presentation. Let's talk about fear of affordability. This is a big one, and the reason that it is because so many of us don't really know what our finances are. How many of us have an actual spreadsheet that we keep track of each month that tells us how much is going out, where it's going, and what's left over? Not many. And that's usually where credit cards come into because we charge things and we don't really know where we stand. If I were to ask you, what is your net worth? How many of you can actually say what your net worth is, which means everything you own as an asset, subtracting all the liabilities? Not very many of us. So that's where the fear of affordability comes in, is simply we just don't know where we stand. So what we need to do is we need to create a spending plan. And in the spending plan, what we need to know is what is our bring home income and what is our outgoing expenses. So what I would encourage you to do is to sit down and look at how much money you're actually bringing home. So that's what you're bringing home on your paycheck. You can look at your bank statements and see what you've deposited, or look at your paychecks from all sources of income. You're going to total that amount. Then you're going to look over and see what your actual debts are. Now, there's two different types of debts when it comes to mortgages. There's your qualifying debts, which is going to be any debts that come up under you on the mortgage. And then there's also going to be your non-qualifying debts, which is going to be anything that's not going to show up on your credit report, but it's still something that you have to pay every month. And the reason that this is important is we want to make sure that you can afford the home. So when you're doing your spending plan, you need to take all of this into account, because on the mortgage side, we're simply looking at your credit report. So what you're going to do is write down all of your debts, anything that shows up on your credit report, and then any expenses that you have outgoing as well. Now, you can get this information from your bank statements if you don't have all the information in front of you, and I'd highly encourage you to go back and take 3 months of your bank statements and itemize all of the accounts to see where your money is going. I know every time that I take the time to sit down and do this, I realize where I'm spending money that I really don't need to be spending money. So it is very helpful. Then what you're going to do is you're going to take your bring home income, subtract out all of your expenses and your debts that you've come up with that you have, and that's what's going to leave over your exposable income. Now in this scenario, you're going to see that the income is $5,500 bring home. Over to the right is all of the debts that we've associated with that are debts that need to continue even after you purchase a home, even if you get rid of some of the Starbucks and the other things. So it's $2,350 outgoing expenses. Now that leaves $3,150 of exposable income, which can be used towards your housing. Now right now you're paying rent, so you kind of have an idea of what you're paying and if you're comfortable with that amount. But what we need to focus on is what is the money that's left over that you can use for a house. That's where you want to start. Then you want to take lifestyle considerations into that. Now, we don't want you to be house poor. We don't want you to get into a house and then now you can't enjoy life. And so we want to take into those lifestyle considerations as well. So I want you to sit down and itemize what's important to you. Everybody's lifestyle is different and they're important. Some people just prefer to have the home and that's their lifestyle. Other people want to travel and entertainment and those type of things. So in this scenario for lifestyle considerations, we looked at $300 for entertainment, $200 for savings and investments, $100 for a clothing allowance, and $200 for travel that we can put away each month for savings so that we can do some traveling. So if this were you, that would be $5,500 net income that you're bringing home, minus the qualifying debts that we already itemized over in the right-hand side, leaves us $3,150. Then we're going to minus out $800 a month for lifestyle considerations, leaving us at $2,350 housing allowance. So that means that when we're looking and we're meeting and we're going over different options, we want to be aware and cognizant that that's what you're trying to accomplish, is keeping your housing under the $2,350 so that you can make sure that you have all of these liabilities and debts paid as well as having your lifestyle considerations met. So that would be step one, is you want to know where you're at. And if you know where you're at, then you're not going to fear being able to afford the home because you've planned for it ahead of time. Fear of paying more for a home than what it's worth. Now, this fear is not as relevant nowadays as it used to be. Now, before the market crashed, there was a lot of homes that were appraised for more than what they should have been appraised for. Now there's so many regulations and guidelines in place that alleviate a lot of those concerns. And what I mean by that is that when you get a mortgage, you go to a lender and they order the appraisal on the home. Appraisal is an evaluation done on a home to make sure that the value is supported for what you're purchasing the home for. Now that's done through a third-party service. So the lender orders it through a third party that's non-biased to the transaction. So if the home is not worth what you're purchasing it for, the appraiser will come back and say, this is what the home is worth. And then we would have to go back to the seller of the home and see if we can negotiate that price down to what the actual appraisal came in at. Also, inspections are really important. You want to make sure that you're getting an inspection so that you know what to expect on this home and that there's no major issues. Because again, that could be part of the fear of paying more for the home and what it's worth. Well, if you get into the home and now the AC unit's not working and you have to pay another $10,000, ideally you paid more for the home than what it's worth because then it wasn't addressed in the price up front. But again, we can alleviate these fears simply by having the proper procedures in place and getting an appraisal and inspection, so you don't have to fear that you're going to pay more for the home. Fear of losing a job and inability to make payments. This is a huge concern for people that went through the crash. I know that it was a concern for me. I've been in the mortgage business for 15 years, so I stayed in mortgage through those times, and I helped my customers with this fear of and reality of not being able to make payments. So it is a logical fear to have to explore and make sure that you are protected if something were to come out. Now, making sure that you are protected and that you have different things in place to make sure this is not an issue is a couple different things. The first one is housing is going to be unavoidable, meaning that no matter what, you're going to either have to pay rent or you're going to have to pay a mortgage. So it's not a fear that you can eliminate completely because you still would have the fear of, can I pay my rent? Now, positive factors of owning a home versus renting in this arena is that you're not going to be evicted from your house. Let's say that you do get behind or you lose your job for a couple months and you're behind on your mortgage. Yes, it's going to impact your credit, but you get to stay in that home. It's going to take a while for you to be foreclosed on a home. So you're not going to get evicted right away as you would if you have a landlord. It's going to give you a grace period to where your family's not going to be up and moved for you to get back on your feet as well as start making those payments. Also, you have the option to rent out rooms or the full house if you need to. If something were to happen, you can simply move out. You can rent out the house until you're in a better situation to be able to make the payments. You can't do that when you're renting a property. The landlords typically won't allow it. Insurance for job loss. Depending on the programs, there are some insurances that you can put in place in case you do lose a job. So if you're in a high risk type job, then we would want to explore those options to see if we can get you in one of those programs that typically will give you 3 to 9 months in rent or in a mortgage payment that would be paid in that insurances if something were to happen. And the most important part about this is making sure you have an emergency fund. When you purchase a home, sometimes you liquidate all of your savings to get into a home. It's super important that if you did do that, even though we don't advise and recommend to do that, that you get your emergency fund up as soon as possible. So that means you may have to be a little bit strict on your expenses for a while, but you want to have at least 3 months of your mortgage payment in a separate savings fund. Typically, we like to see 6, but 3 months of your mortgage payment in a separate savings that is your emergency housing fund. So if something happens to the home, if there needs to be repairs, or if you need to make a mortgage payment, you're going to have that in place. So that's going to help you alleviate the fear of losing your job if you have these practices in place, and knowing that you're going to have to pay housing no matter what. So even if you're renting, you're going to have to pay a lot in fees, but also you're going to possibly be evicted from your home, and you wouldn't have insurance for job loss, and you probably don't have an emergency fund as well at that point if you've exhausted your funds. So let's talk about fear of buying a home with major flaws. We roughly talked about this initially, and on this, we want to take into consideration the things that we can do up front during the process when you're buying a home to ensure that you look at the property. Now, again, inspections, I can't stress that enough. You definitely want to get a home inspection on the home. The home inspector's job is to go in and be your advocate. They are going to pick apart the home and find every little thing wrong with it to ensure you know what type of property you're buying. There's always going to be issues with home. Unless you're buying a brand new home with a warranty, you're always going to have issues with the home. You just need to be aware of what those issues are and make sure that you're comfortable with them. Also, there's an option for a home warranty. A home warranty is separate from home insurance, and it's a 1-year home warranty that you get when you purchase a home. You do have to pay for it or negotiate, maybe a seller pay for it. But it will ensure a lot of the major things in a home for the first year. You need to look at the home warranty to see what is going to be included in that, because all of them are different. But you can get a home warranty that covers a good portion and add different things to it. So in that first year, typically you're going to know if something is wrong. This is going to help you know that you have that little bit of comfortability that if something goes wrong in the first year, you would place a claim with the home warranty and simply pay a trip fee that's usually $50 to $75, somewhere around there, versus having to place a claim with your insurance company for your homeowner's insurance. So that alleviates the fear of major flaws. As long as you do the proper inspections up front and know what you're dealing with, then it's not going to have that fear moving forward. Also, we want to look at fear of choosing the wrong type of mortgage. Now, this is why it's really important that you do work with someone like my team, the certified mortgage planner, versus a loan officer. That's because, again, we are held at a higher degree, a higher board of standards, ethics, and then also we have a lot more planning in place to make sure that you're getting into the right type of loan that's going to work for you long term. As a mortgage planner, we're not just looking at putting you in a loan. We're going to look at what are your long term goals. Do you have college funds set up? Do you have retirement set up? And how does this all play a factor into your mortgage? Also, we provide you with the education that you need to make sure that you're fully comfortable moving forward and that you can have a successful financial portfolio, including your mortgage in that. Fear of the housing bubble and the burst cycle. So this is a huge, huge, huge topic, and that's why I'm so glad that you're on here today, is I want to be able to go through and talk quite a bit about the current housing, what impacts that, because there's so many misconceptions and reasonable fears that are out there right now based on what we saw with the housing bubble and where we are today. So we're going to go over a little bit, well, quite a bit of that in detail. So first, let's talk about the housing market trends. This is really where we see the housing market risk. This is really where we want to spend a lot of time investigating and learning, and that's why I'm giving you the information in a way that you can understand it here, because this is where you're going to feel most comfortable making a decision either to purchase or not to purchase based on where the market is. So let's jump in. So the 3 risk factors is going to be your supply, your demand, and then affordability. Now, supply is going to be what's the inventory, what are new home starts, that's new homes coming in. as well as the demand, which is going to be how are employment ratings? What is the investor activity in our local market? And what is the consumer confidence? How do consumers feel right now about spending money, which is the main factor in the housing market. If people are feeling good about spending and they keep spending, guess what? It's a great housing market. If employment's doing really well, guess what? A great housing market because people can afford to pay the mortgages. And then we're going to talk about affordability, which is going to be, again, one of the main factors of the housing market trends and risk with buying a home today. Because there's only three things that are evident. Either prices are going to go up, they're going to go down, or they're going to stay the same. So we're going to look at a couple different reports. We're going to look at the inventory, U.S. Census Bureau. We're going to look at that on a national level through the National Associations of Realtor, as well as the local Board of Realtors. And then we're going to look at new home starts. So we're going to look at the U.S. Census Bureau, which is on a national level. And again, we're going to take it back to a local level at the local Home Builders Association. So first, let's talk about housing supply. What is that? Housing supply is going to be a ratio. So what that means is that we're going to take the total number of homes listed for sale divided by the total number of homes sold each month, and that gives us our housing inventory and how many months that the homes are lasting. So pretty much how long is a home going to be on the market before it's sold, which shows us the demand. So we're going to look here first, and this is going to be from the Harvard Joint Center of Housing Studies. And what we're looking at here is going to be the months of supply for inventory. So you could see here that we're listed at under 4% or we're looking at under 4 here for months of supply. So nationally, we're under 4 months of homes being on the market, which is unbelievable. Because if you even look all the way back from, go all the way back to 2012, we're under six months. So anytime we're under 6 months, you're looking at a buyer's market, which means there's a high demand. So that means that we've been continued all the way through here that we've had a really high demand in housing. And so that is a really good indicator that we are in a very strong housing market. Now let's look at the local level. So this is from the MLS, which is the Multiple Listing Services here locally. And this is just pulled up in Placer County. This shows us the months of inventory. So you can see from September to the last reporting date was February, where we're at as far as how many months the housing was sitting on the market. So you can see we're actually even less now. The demand is really high for housing. So is it a buyer's market or a seller's market? Again, that's going to be depending on how many months of inventory that the house is sitting there. So you can see 6 months is a balanced market. And if we go back to the slide that we were looking at previously, nationally, we're under 6%, we're at 4%, and then locally you can see we're under 2 months. So we're in a really strong buyer's market. So again, here, if you're under 6 months, you're in a buyer's market or a seller's market. I'm sorry, we're in a seller's market under 6 months. I realized I just said that backwards. And then anything over that's a buyer's market. So that means really high demand when it's a seller's market, and then really high supply when it's a buyer's market. So let's talk about the difference with certified mortgage planning specialists. Now, if you are in a high demand market, you need to make sure that you're utilizing the right products, tools to get the highest amount of offer in, but still be reasonable in the amount that you've budgeted for in your spending plan. So what this means is we just take two basic scenarios. So you can go to a regular loan officer and they say, okay, you're approved at $200,000 with 5% down plus closing costs, and here's your estimated payment at $1,289 or $1,286. Now, as a certified mortgage planning specialist, we're always going to be looking at ways to be most competitive for you to put in an offer, but still, again, fit in your spending plan. So knowing different options, I would suggest that we go with the 3% down, and that would be at a $210,000 purchase price. And you can see here your payment doesn't go up much. It goes to $1,298. Now, the difference between every $10,000 finance, you're going to be looking normally at about $60, and you notice this isn't. That's because there's different ways that we can structure a mortgage to make sense for you and your out of pocket and get you to a lower payment. But again, you got to be working with someone that's creative with mortgage planning. Both of these options are just about the same out of pocket. So you're not putting more money down here. They're about the same between both options. The payment's not much different. But what this means to you is that you're going to be able to go and afford $10,000 more in a home, which allows you to be more competitive. So that's going to be a big help when you're structuring. Now, all of these payments are subject to credit and, whether you qualify. And so these are not specific, but a good way for you to look at the difference between a standard mortgage versus working with a certified mortgage planning specialist to be creative for you in this type of really high demand market. So let's continue looking at some additional statistics. So this chart here is going to be looking at 1 to 4 unit dwellings that are reported by the U.S. Census Bureau. And these are housing starts. So it's a really great indicator because it measures how many new housing units will be coming on the market in the next 12 months. So it's not just going to show housing as far as how many months are on the market. It's going to show what are we looking forward to, because that's what we really want to know is, yeah, the housing market's great today, but what's going to happen in the next 12 months, 2 years, 3 years on down the road. And of course, we can't really depict that. There's so many factors that are in that, but there are some triggers that we can look at that's going to indicate how that looks. So the housing starts is a really good indicator because a healthy number of new housing units is somewhere between 1.5 million range, and even at the height of the housing boom, we were over 2 million new home units per year. And at the depths of the housing crash, we were only at 500,000 per year. So right now we're building at approximately, you see, 1.2 units per year. So that means that the new home construction market is likely to improve significantly in the next year or so. So in fact, many economists are estimating that we'll be increasing the current level of new constructions and get back up to the 1.5 million range relatively soon. So that, again, is another indicator to show a really strong housing market. So now we're going to talk about demand. So we're going to be looking at the local employment situation, local investor activity, and then consumer confidence, which is, again, the emotion of how consumers are feeling about spending money. And that's going to be through the University of Michigan Consumer Confidence and then personal experience as well. So again, here's another Fred report. This is going to be the unemployment rate. So what we need to look at is going to be, how is the economy doing? And a good indicator of that is going to be the unemployment rate. This goes all the way back to the 1950s, but you can see that during the recession of the 1990s, how the prices suffered and went down. And then once the economy improved in the 1990s, housing prices went back up again. And during the latest recession, the unemployment rate went up dramatically and the housing market suffered as well. So now that the unemployment rate is very low, people feel more confident about buying homes, and the housing demand has greatly improved. In fact, the employment situation hasn't been this favorable since, 2005, 2006. You can see we're only at 4.1% employment rate on the national level here. Really good for unemployment, which means the economy is doing great. Now we're going to be looking at the unemployment rate here in California. You can see it's at 4.3, so a little bit higher, but still amazing, doing amazing on the unemployment rate there. Went from a peak, up here 12.3 during the height of the recession, and now we're down to 4.3. So that's how people say, I don't want to go through the crash again. Well, look at the information here. You could see that completely different market and policies in place to ensure that that doesn't happen again. Before, people were in adjustable rate mortgages, so when they lost their job, not only did they lose their job, but their mortgage payments often went up triple because they're on adjustable rate mortgages, and that's not the case anymore. So now we're going to be looking at the JOLTS report. This is actually even a better estimate to look at than even the unemployment rate. And the reason why is because the unemployment rate takes into account people that really aren't looking for a job or don't want a job. And so this one here at the JOLTS report shows how many job openings there are. Now look at this. From the crash, look how crazy it went up here and how amazing we're doing. This is really good report numbers here to show that there's tons of jobs that are still open, which alleviates us going through another crash, because what stimulates the crash is people losing their jobs, not able to afford the homes and all of that. So we're doing really good in a really great market right now. This one here, you're going to be looking at consumer sentiment. So this shows us how consumers are feeling about the market. And it becomes apparent when we look at this sentiment report that a consumer sentiment reading above 80 is strong and a reading above 90 is very strong. And we're at 99.7. So now we could look at the homeownership rate for Placer County, which is at 68.8% and 54.2% in Sacramento County. So it's still climbing, which means that we're doing really good here in our areas, and that the demand is now reflected in the homeownership rate, and we're doing really good in a housing market. The other factor that we want to look at for demand is the demand for investor activity. So investors typically take up 15 to 20% of the market, which is um, pretty much where it's a healthy market for investors. So that's a really good snapshot there as well. So now we talked about housing supply and demand, which are the two major factors of where we're at and where we're going. And as you can see in all those reports, everything is super strong. The economy is doing well. And so the likelihood of a crash, very slim based on those numbers. And all of the sentiment, how consumers are feeling, still great housing um, industry that we're looking at as well. And so now we're going to talk about housing affordability, because although the housing is doing really great and the demand is really great, which is great for housing prices continuing to be where they are rising and not seeing a huge correction on that, we need to look at affordability. Is the mortgage sustainable for you long term? So we're going to be looking at the Housing Affordable Index, interest rate market and lending guidelines, and then also affordability specific to customers that I've helped and what we would look at rent versus buy here in our area. So this is the Housing Affordability Index. So this shows us how affordable is housing to local people that are in the area. And so we're going to look at how many people can afford housing and mortgages, or mortgages specifically. Now, when you're looking at this number here, 100 means that a family with a medium income has exactly enough income to qualify for a mortgage that is the median price for the home in the area. So anything over that means that that's additional income that they have, so it is affordable. So you could see here it's 163 is what we were rating at in January, which means that they still have over 63% available past the median income. So that is really good. And again, this is based on different factors. They take the information from conventional financing, 80% and medium period of existing single-family homes on it. But that is a really good indicator that the housing affordability is still affordable in the area. Now, there are different areas, of course, and income range and things like that. But in the 1990s, the affordable index was generally between 120 and 140. And we're at 163. In the housing bubble, it hit a low of under 100 because people couldn't afford their homes. So this makes today's reading of 163 range very affordable by historical standards, which is a really good indicator. Now we're going to look at average price appreciation from 1989 to 2017, because one of the concerns is, well, that's great that we're going so high now, but at some point, it's going to correct, and what are we going to do? We're not going to have the appreciation. And so again, the only way that we can judge the future is by looking at the past. And so this chart is going to show changes from housing during all the way back to 1989. So even taking into account the huge decline in house prices from 2007 to 2011, average rate of annual house price appreciation is still over 3.76% per year. So that's really good. In our case studies throughout the courses that we've gone through in education that we've been provided, in most of our client conversations, we use 3% rate of housing appreciation for forecasting purposes. So we use a very conservative number, and this number here, based on National Association of Realtors, is even higher than what we use in our scenarios and numbers that we go over. So again, we just addressed all of the fears out there. And again, a fear comes from not having enough education and not knowing enough about the market. So I hope that going over all of this, that you feel more comfortable. But again, if you have questions, please reach out to me. I'm more than happy to go over your specific questions with you as well. Now we're going to get into responsibilities of home ownership. And so we're going to get into a little bit, now that we've talked about the market and why it's still a great time to buy and how the market's doing, we're going to talk more about the mortgage side of what you need to know. So as you're probably aware, there are a lot of responsibilities with homeownership. You need to make sure that you make your mortgage payments on time. You need to make sure that you're paying your property taxes and your insurance. Now, typically when you purchase a home, depending on the program, that will be included in a total payment. So you would just make the payment to the bank, and then bank would pay the property taxes and insurance when they're due. But you need to be prepared to pay them, as well as any repairs and maintenance to a home. And then you typically will have to purchase additional appliances and equipment for the home as well. Included in a home purchase, you have costs that you have to worry about or be prepared for, which is going to be loan fees. So getting a loan, there are some fees that you have to pay in that. And then also credit report fees for pulling your credit report, appraisal, again, to make sure your home is worth what you're paying. You do have to be prepared to pay an earnest money deposit up front. An earnest money deposit is simply an amount that you give to the title company, which is a third party that handles the transaction to make sure. In some states, it's an attorney, but they make sure that there's nothing biased going on. That everybody, the lender, the title company, the agents, all have to work through the third party title company or attorney to make sure that all the information is provided and all the money is handled. And so you would place a amount, you'd write a check, let's say $2,000, whatever you agreed on, and you would give that to the title company. They would cash it and hold it in your escrow account there. That money would be used towards your purchase, but you need to be prepared to pay that up front. So you do have to have funds available that are sourceable funds. Also, you have to have down payment. Some programs allow for no down payment. There is down payment assistance, VA and USDA financing that don't require any down payment. You would just have to pay for closing costs unless otherwise negotiated or utilized in a down payment assistance program. And then any other inspections other than the appraisal, you would be paying for out of pocket up front unless you negotiate otherwise with the seller. So again, we're going to go over the cost. Lending fees is for the lender to underwrite your file, which is the person that approves your file. Processing department processes your file. And then closing fees, etc. Different lenders have different fees broken out in different names, but we're all regulated, so we're all pretty close to the same amount in cost. You just want to make sure you're working with a team and a certified mortgage planning specialist that's going to put you in the right programs. Then again, you have title, escrow, attorney fees. Again, this is the third party, whether it be a title and escrow, an attorney, and their fees associated with handling the transaction, as well as insuring the title. So you get a title insurance just like when you buy a car. You're going to ensure that that title is going to ensure that there's no liens or anything that's attached to the property when you take possession. So it's a really good insurance to pay for, because if something comes up later, the title company is going to be responsible, not you. There are prepaid and impounds, which is for your taxes, insurance, and interest. And so whenever you purchase a home, property taxes and insurance are required. The first year of insurance has to be paid at closing, and then depending on when property taxes are due, there is some additional reserves that have to be collected. And then there's buyer agent commissions. So as a buyer, typically you're not paying those commissions. Typically it's going to be the seller of the property that pays both the agent's commissions. But sometimes we'll see it where it's negotiated that the buyer wants to pay the commissions and get a reduction in the purchase price. It's not typical, but just know that you're typically not paying for your agent. The seller is. But when you sell your home down the road, if you do, you're going to have to be paying those fees. So home purchase costs. Now we're going to talk about monthly expenses and additional expenses with moving. So PITI means your principal, which is the loan amount that you are borrowing. The interest is the amount that you're paying the bank for borrowing the money. Property taxes and homeowner's insurance. If you're in a flood area, you'd also have flood insurance. So when we say PITI, that means your total payment, including the amount you have to pay the bank back, the interest for borrowing it, property taxes, and insurance. That's what we're going to use for qualifying. Now, depending on the program that you're in, you may have mortgage insurance. Mortgage insurance is typically required when you put less than 20% down, and it is an insurance for the lender if you go into default that we could place the claim with the insurance company and get some of the money back. So because it's a riskier loan that you're putting less down, it may be required as an additional monthly payment, and that would be included in with your PITI and paid to us each month, or the lender each month, included in your payment. Mello-Roos, some areas have additional Mello-Roos, which just simply means that it's attached to property tax and it's an additional tax assessment to the property for something. Maybe they built a new roadway or schooling or something of that nature, and they've attached it to the taxes. So you need to be aware to ask your agent on that too, to find out if the property has any additional Mello-Roos, but they should tell you if it does. HOA is homeowners association, and so condos typically will have a homeowners association, which is an additional monthly payment that you pay because of the common areas of the unit, subdivision, or condo association upkeep. So typically, if you're in a condo, usually, but you need to look at the master policy, it's usually from the insulation inside the walls, outside that they cover, and you would cover the inside of the home. But there are some subdivisions that also have HOAs for maybe a common swimming pool or a community house that you would have to pay. You would have to qualify for that, and then you would pay that portion directly to the homeowners association after you purchase the home, not to us, the lender. Then you want to be prepared for moving expenses and emergency reserve funds as well. We're going to talk briefly about loan features and terms. So interest rates, there's fixed rate loans, there's adjustable rate mortgages loans, and then there's rate adjustment periods and caps. The rate adjustments are how often those adjustable rate mortgages would term. So you typically, if you're just dealing with a normal 30-year fixed rate, you wouldn't even need information around ARMs, but just know that if you get into an adjustable rate mortgage, we would go over rate adjustment periods and rate caps and give you more information about that. Repayment term is how long the loan term is for. Typically, you're looking at a 30-year, but you can get a 10-year, 15-year term, depending on how comfortable you are with the payment and what your long-term goals are for paying off the mortgage. Prepayment penalties are pretty much no longer existent. There are a few loans that have them, but simply if you were to pay off the mortgage before a certain amount of time, you'd have to pay a penalty. Not the standard, not something you really need to be concerned with. Locking in your rate, you can't lock in your interest rate until you actually have an accepted offer on the property and you reach out to the lender to lock in the rate. So there is going to be some variance from when you get an initial quote to when you actually purchase the property. The rate could adjust up or down. So you need to have a little bit of wiggle room in your payment comfortability. And then also approval process and schedule, which we would go over. So how much can you qualify for? That is the big question. Oftentimes people will come and say, what do I qualify for? Which is probably the majority of people. And we'll tell you that. But again, as a certified mortgage planning specialist, I'll ask a lot more questions and find out, what are you comfortable paying? Have you created a spending plan? Do you know how much money you have left over for housing at the end of the month? And are you comfortable with that amount? How much down payment do you have? And then also looking at guidelines for different programs is going to be another indicator for that as well. We're going to look at loan to value. So what loan to value means is how much money are you going to put down versus the purchase, so your loan against your purchase price after you put money down. So for instance, if the lender is willing to lend up to 90% of the property value in a specific program and the property appraises for $200,000, that means that you're going to have to put down 10%, which is going to be $20,000. So that means your max loan amount would be $180,000. Debt to income ratio. As lenders, we look at this to see what you would qualify for. So again, in our first example, we talked about all of the debts, and you have your credit report qualifying debts. That's where we take into account in your debt to income ratio. Unless you're VA and you pay child care and some other small program things, typically we don't take any of the other expenses that you have into play. We would just take your total monthly debt payments compared to your gross monthly income. Now, what's different from this versus your spending plan is on your spending plan, you're going to take your net income, which means after your deductions from your paycheck, because that's what you have to play with each month. Versus when we qualify you, we're going to take your gross. So before taxes come out, we're going to look at your income, then deduct your debt, which helps you to qualify for the mortgage a little bit more than what you may even on your spending plan. So it's going to take the lower your mortgage payment debt, the bigger your mortgage you can get. And then total housing expenses, we're going to take your total mortgage, principal, interest, taxes, and insurance, any mortgage insurance, HOA dues against your debt. And typically we want to look for 45. Sometimes we can get you a little bit higher on that ratio. So for instance, on the debt to income ratio, let's say Lee and Shauna earn $60,000 a year. And again, this is gross before tax deductions, or $5,000 per month. So they can carry a maximum debt load of $2,250 at 45% debt to income ratio. So their only debt reporting again on their credit report is just a monthly payment of $275, which means they can qualify for a mortgage of $1,975. Now, again, we may tell you $1,975 and you may only be comfortable with $1,400. So it goes back to the spending plan of what can you comfortably afford. And we're never going to push you to qualify for higher. We're simply going to provide you with options, but we want to start with what you're comfortable with. Down payment is going to be a huge factor to that payment. The more you put down, the lower your payment. So we want to utilize any payment or down payment sources that you have, which can be savings account, checking accounts. Maybe you can liquidate assets that can be verified as liquidated, which is like cars and things like that. Private gifts and loans. Loans typically are like second mortgages and things like that, but you do qualify with the payment. And then private loans would be from family members where they can verify they're gifting you the money. Retirement accounts, second piggyback loans, VA loans and USDA loans, again, zero down payment options. And there are some down payment assistant programs for first-time home buyers as well as non-first-time home buyers that we can look into if needed as well. FICO score, which is your credit score, is going to be a huge indicator to your availability of programs as well as your interest rate and payments for your mortgages. So we want to make sure we're looking at that. Your ranges go from 300 to 850. Typically, you really want to be at, we can go down to a 580 credit score, but for pricing purposes, you really want to have that credit score a lot higher depending on the program that we're looking at. And then down payment assistance, you need at least a 640 credit score. We take all three credit scores and use the middle, and we use the lower of all applicants' middle score. And it does highly impact your interest rate. So we want to work on improving your credit. So you want to make sure that you maintain improved payment habits, repay collection accounts. Now, this one here, I put depends because you really want to speak with the lender before you pay any collections account. You can potentially pay one and make it worse on your credit. So you want to make sure you reach out to a certified mortgage planning specialist such as myself to go over that side of it as well before you move forward. Reduce your total debt. Don't close any accounts. Avoid opening and closing accounts because it can hurt your credit score. Again, if you need help with getting your credit up, you want to speak with a certified mortgage planning specialist such as myself before you do anything because it can hurt your credit. But you want to make sure all your credit limits are at least 40% under what you can charge, so your balance is under 40% of the total limit, and correct any errors on your credit report. But again, you really don't want to dispute because that can create issues down the road. So again, speak with my team before you move forward. And then we're talking about pre-qualification and pre-approval. So there is a difference between the two. A pre-qualification is you tell me, here's my scenario, and maybe we don't even pull credit. And we say, okay, based on the information you gave, here's the qualification price range that you would be pre-qualified for. A pre-approval, which is what you need in order to look at homes, means that we have to look at all your documents, verify information, and then we can issue a pre-approval letter. If you were to take an application, give me all the documentation, and I have everything I need, I can issue a pre-approval within 30 minutes to an hour. It doesn't take that long. But if you don't have all the information up front, then we can't issue the pre-approval until we have it. Pre-approvals are typically 30 days to 120 days that they're good for. We just simply update information as needed and reissue the pre-approval letter. It's not a problem. So what you can expect from my team as your lender. So this is my team here. I love my team. I'm super, super blessed to be working with them. I'm in all blue, so Kristen here. And then my loan officer assistant is Ashley, and she's the blonde. And then Jim, my other loan officer partner, is there to the right. But we love working with our clients, and we're so excited to work with you. We know this is a huge, huge investment into your future. But what you can expect from us is honesty, integrity, by far number one priority for my team. Clear communication. We have a system in place to make sure that you're communicated with. You're not wondering what's going on. We educate, provide options so that you can make the right decisions for you. We never are trying to force you into anything or push you into purchasing. We know that when the time is right, then you'll purchase at that time. We'll issue the pre-approval and make sure that you have a smooth closing going through the process once you find your home. Shopping for a home. So how are you going to find a home? Now that you went through the process, say you got your pre-approved, how are you going to find your home? Well, you definitely want to work with a real estate agent. Even if there is an agent on the home, it is a good idea for you to have your own real estate agent simply because you want to make sure that they're working for your benefit and they're negotiating for you. Again, you're not paying their fee, but you want to make sure that you're working with someone that's a good fit for you so that you can stay loyal to them and work with them throughout the process, and they'll make sure that they're doing their best to get you the best price for the home as well as help you through the education and all the information that you need throughout the process. You can also view online listings from your realtor site. I highly recommend you don't go to other sites because most of it is outdated information, which gets really frustrating when you find a home that you love and it's already been sold. The agents have all of the accurate information that comes directly from the listing services so that it's current information. So you want to make sure you stay on their site. You can look at for sale signs as you're walking or driving through the neighborhoods and open house events. When you're going through the open house events, you just want to let them know that you are working with a real estate agent so that they're aware of it. And then, of course, if you hear of a house that's on the market in your area. And then using a real estate agent, again, I can't stress the importance of this. They're negotiating for you. They have access to the listing services. They know what's going on in the market. They can help you through the guidance through the process. They handle all the paperwork with you. And the incentive to succeed is really the agents only earn a commission when you buy. So they're on your side to buy and be able to help you find the right home for you. Making an offer, you're going to need a lot of information. On the offer, you're going to have the property address, the offer price. Again, we talked about the earnest money deposit. You'll write there how much you're going to place in escrow. It'll have the down payment amount, financing terms, closing costs will be deducted, an estimate of it, personal property to be conveyed. So if there's any personal property you want with the property, it needs to be listed on the contract at no value. It's going to tell you your closing date, possession date, and then also the expiration of the offer and contingencies. So when you're going over the offer with your agent, you want to go over all these details so that you know how you're moving forward. Common contingencies include financing. So it's going to give you a contingency. Contingency is so many days that you have to get through that stage. So it's going to say, for instance, a financing contingency standard is 21 days. So they're going to say, we want you to have an approval with the lender within 21 days, which isn't a problem. So you'll go through and you'll put 21 days, and that means in 21 days they want to know that you have your financing so that you can say that you honored that contingency. And then there's inspection contingencies for like the appraisal and other inspections that you get. Well, they're going to give you so many days to be able to do all your inspections, and if you decide before that contingency date is over that you did the inspections and you don't want to purchase the home, you can back out and get your earnest money deposit. Now, you want to make sure you go over all that with your agent because they'll have the details, and I'm not specific to your transaction. But that's what contingencies are, is they put processes in place to ensure that you can get your money back if something comes up during that period that doesn't work out. So you don't have to be worried about, being committed to the property that you don't know 100% until you do get those inspections and you do get your financing in place. Now, after you put in an offer, they're going to consider your offer, and they can either accept it at the terms that it is, reject it and say, no, sorry, thank you for putting an offer, but we're not interested, or counter. If they counter, they may come back and say, we like your offer, but we want A, B, and C. And you could choose to accept it or not. So once you accepted an offer, you're going to reach out to my team. We're going to discuss the options at that point. If they've changed the loan, the rate, the fees, we're going to go over the timeline, all the expectations through the process, discuss your loan approval, make sure we have everything that's needed. And then throughout the process, we're going to go over the appraisal, review it, make sure there's no issues. If there are, address them with you, let you know what your options are for moving forward. And then once you're fully approved, we'll set up your signing appointment, go over everything with you. And then once everything has recorded with the county, you are the owner of record and you get to get your keys. Such an exciting time. Now, through the closing process, there are a couple things that you want to make sure you do with your agent, which is the final walkthrough. And then also, we're going to be reviewing our closing statement together to make sure all the numbers are correct before your closing. Our team typically tries to be at the signing with you just to answer any questions, review all the documents, you'll sign them. You'll write a check out or wire directly over to the title company the amount that's due. So let's say that you have to invest $10,000 into this home and you already wrote an earnest money deposit for $2,000. That means you still have $8,000 that's going to be due. So when you go to closing and you sign all your documents, you either have to have a cashier's check made out to the title company or wire directly to the title company the additional $8,000 from the accounts that we have verified. So successful homeownership means finding the right loan for you, making sure that you have mortgage payments, you're making them on time, you stay current on your property taxes. If they're not included in the loan, if they are, then we pay them. Maintain adequate insurance. If you ever change insurance, you need to notify the lender that you've done so to have it updated. Keep the home in good shape. Keep an emergency fund ready, so if something were to come up, you could feel comfortable. And then you want to avoid borrowing against your equity for consumer purchases. Now, there are some times where it makes sense for you to refinance, and I can help with that after you've purchased your home too, where it may make sense for you to refinance, save money to where we can now talk about investing that into your future net worth and different options that are available for that as well. So sometimes it does make sense for you to do that. Now, what is your why? Now that you have all the information, you can feel so much better and not really be fearing about things because you're going to be ready and you know what to do now to make sure that you're in the place to make those decisions. You really need to connect with why you're doing what you're doing. Because if you don't know what you're doing, then you can't reach the goals that you're trying to reach, or we can't help you reach those goals. So are you doing this because you simply just want security for your family? You don't want to have to move anymore. You don't want to get evicted. Maybe your landlords the last couple of times have sold their properties and you have to move. Maybe you just want to do it for a future investment or retirement. You really need to connect with your why. A little bit about me is why I got into lending, or why I'm so grateful that I'm in lending is, I grew up in a home where we moved often. We moved almost every year. My mom was a single mom most of my young childhood, and so we had to go wherever she can afford. And so I had to move schools often. I didn't get to have, friends stick with me because we were moving schools. And I remember when my mom bought her first house and I was in 6th grade. And it was huge for me because that was the first time we were able to stay in a home and I was able to start making friends. So for me, it meant security. And for me in my life, it has always been a level of security to know that I have my home, my space, and that I'm taken care of, that my family's taken care of, and that my kids are taken care of. Other reasons just you can make your own rules. You can do whatever you want to the home. We just in our new home we put in a new backyard the way that we wanted to. When you're in a landlord's home, you're not going to invest money into their home, so you're just dealing with however they have it. Another part of my why was for my kids, and this picture here where it has all the trucks and the tanks and all of that on the wall. The first house I bought, I did this for my son's wall. I put the trucks and all of that around there, and it's crazy because he's 16 years old today and he's driving his own car. But it meant so much to me to be able to make that space his own and to be able to do that creative stuff on the wall and not have to worry about what the landlord's going to say. And it was our place and our space. And the new home that we purchased a couple years ago, our intention with that home is for retirement. We plan to have that house paid off by the time we retire, or close to where we can sell the home and we can go and buy two separate homes in two different areas. We'll probably purchase a home here shortly in a different area already, but it's for future investments for us to be able to season hop. We want to be able to go to where the weather is going to be warm when we're retired. So right now our intention with the home is investments. So we make sure that we're utilizing the mortgage the way that we need to so that it does that by the time we want to retire. So connecting with your why is going to be super important so you can help inform us as a certified mortgage planning specialist team to meet those goals for you, not just with this loan. We're going to continue staying with you throughout your process in your life, and as you make changes, we want to make sure that we're continuing to work towards those goals. So again, some of the benefits for owning a home, as we've already went through, is building wealth, retirement plans, potential tax savings. There's a lot of changes with taxes, so it may not be as big of a benefit as it was depending on your income level, but pride of home ownership, security and safety for the family, building good credit, pets. There's a lot of pets that are banned from certain landlords and properties, and so being able to have your own place with your pets is a big thing for most people that have those pets. And then legacy for your children. Do you plan on keeping that property for your home, or your kids, or maybe selling it and dividing and them creating their own legacies? Now the big important question is rent versus own. Does it make sense for you to purchase a home? And really, it's going to depend on what the market's doing, but I want to go over this scenario with you. Now, let's take into account a home right now at $400,000. The rent is $2,500 or more. Rent, as you probably know, is skyrocketed, to where it's in some areas it's almost unaffordable, and it makes more sense to purchase a home, which is crazy to think about it that way, but it is. So, home purchase price, let's say it's $400,000. Down payment, let's say you only put 3% down. We added in some estimated closing costs, and now we're looking at a mortgage balance of $388,000. Let's say interest rate is 4.5%. Now keep in mind, the rates are subject to whatever you qualify for, your credit scores, and whatever the rates are at the time. But just for a scenario basis, we're going to look at this. Your estimated principal and interest payment, which means that's how much you have to pay, $1,965 for 30 years to pay off the mortgage that you borrowed and the interest that you owe the bank for borrowing it. In this scenario, we do have to pay that mortgage insurance because you're putting less than 20% down. We have an estimate for property taxes and insurance as well. So you're going to see here your total payment, including the taxes and insurance, is roughly $2,558, less than what you would pay for rent here. And that's not even accounting for any tax interest that you may be able to deduct. Now you have to speak with your CPA, and there are some changes, so that's why I'm not even including it, because I want to show you that even not including that here, a tax bracket, we didn't even put anything, doesn't even take that into account. Now, again, we looked at the slide where it shows that it was over 3% for home appreciation, even in an overall segment of the ups and downs of the market in all the years. So even using a conservative amount of 3 years, let's say that you hold the home for 7 years and you pay 8%, let's say, and it shouldn't be that much, but let's just say you sell the home in 7 years at 8%, your rate of return is 5.5%. that you're looking at on that home. So your mortgage is not much more than what you're paying for your rent here, as you can see here, and that doesn't take any tax deduction. So if you have tax deduction, it's going to save you even more that you're looking at. But this shows you, because again, as a certified mortgage planning specialist, we're looking at wealth, not just putting you in a loan. So this shows you here, if you buy the extra wealth that you're going to have in that holding period of 7 years, and then you can see here, we're not using any tax or tax benefits here. Cash required to close, depending on how much you put down for closing costs and down payment. Roughly, we're just saying $20,000 for a down payment, closing costs. And rent, you would have to pay a deposit, for deposit first and last. So you're looking at about $5,000 that you'd have to invest here. But look at the future value of assets. This is huge. You can see here the equity based on the appreciation and how much you pay down your loan versus how much you paid your landlord for rent. So this is cost, this is gain. So you're paying your landlord's mortgage and you're losing all this money, and then how much you're gaining based on a 3% appreciation. So you can see just in that scenario here that all of these fears that you have are valid fears. Hopefully we've educated through those to where you see that it is a great market. And as long as your affordability is within range to where it makes sense, there's no reason that you shouldn't buy. So we want to do a cost scenario with each of you to see where you are specifically and see if it makes sense for you. Because if you wait, it's going to cost you money. So here you can see in this article, simply it's just saying waiting 1 year could cost you a $30,000 mistake by waiting, depending on what the market does and where interest rates go. So I want to just give you some of my clients. These are actual clients of mine. So let's take Ryan and Victoria. They purchased a home May of 2016 for $410,000. They sold their home. They just sold their home, and the sales price was $510,000. That means they gained $100,000 in equity during that time, which allowed them to buy a bigger home because they just had their second baby. So it allowed them to expand their family, take that equity, and now move up into another home. And we could take this next scenario here. They purchased a home September 2014 for $285,000. We just refinanced their home in January. The value came in at $360,000 then. So that was $75,000 that they gained in equity, and it allowed them to be able to refinance into a lower payment because they have that equity position. So again, I told you it's not just about the first loan, it's about making sure you're meeting your goals long term. So if there's ever a position where you can save more money, we'll reach out to you, we'll set that up and talk about strategies for you to invest the difference into something so you're building your financial portfolio beyond just your mortgage. And then we'll look at Leon. So Leon purchased his home in October 2015 for $535,000. The home appraised September 2017 for $600,000. I just looked it up. It's roughly about $638,000 now today. So they gained over $65,000 in equity on the home just from October 2015 to September 2017. So it allowed them to refinance into a lower payment. So these are actual live case studies that I've done to show you the benefit of purchasing a home and the cost of waiting. Is there any questions? I'd love to go over any specific feedback. If you have any, please reach out to me. Let me know. I'd be more than happy to meet with you and go over those. Again, I can't stress the importance of making sure that you're working with a team that's providing all of this valuable information, content, and making sure that we're looking at not just your loan, but your long-term objectives for purchasing homes. So please reach out to my team. We'd be more than happy and love to assist you with that process. So what are you going to decide to do today to ensure you get what you want and at the greatest return on investment from your home? What we talked about is reviewing your spending plan to ensure comfort and affordability, and then schedule a free mortgage planning session with my team. That way we can sit down with you. Even if you're not looking to buy today, let us meet with you because there may be things that we can work on now to where in the next year or two, whenever you're ready to buy, it's going to set you up for success. And that's what we're about. If you come in, we do a free mortgage planning session, and we find out that it's not the right time for you to buy or you're not ready to buy, we're not going to ask you. We're going to simply help you make sure you're strategized, and that way you're set up for success when you are ready to reach out to us. We'll help you get pre-approved so you can start looking at homes so that you can find your home and build memories and equity in that home. So share your family's progress with our team too. We love it. And there's nothing better than somebody reaching out to us in a year or two and letting us know how they're doing. We check in and see how you're doing because we simply just care. We want to make sure that you're in the best position that you are, and it keeps us motivated and moving forward when we know that you're successful long term. So we love to see your growth and be a long-term resource for you and your family. So again, this is Team Cooper, Kristen Cooper. I hope you enjoyed this session and got valuable information. Please reach out to us and let us know how we can assist you. Homeownership is such an amazing step in your future and a huge part of your overall financial portfolio, and we would be delighted to help you in that process and help educate you in everything that you need to know to make a solid and good decision. Thanks so much for your time. We look forward to hearing from you soon.